Happy Friday, everyone. Jason Jacobi here with your closing bell for the week. Lots to digest in the markets and in economic data and some other news that we'll cover. But let's dive right in. The NASDAQ, Dow Jones, and S&P at the time of recording look like they're all going to be down over 4% for the week, which is obviously not a good week. We here at Boyer Financial have been preaching short-term volatility, which could lead into opportunity and long-term growth. So again, first thing, which will kind of lead into our jobs and data report, with the Fed raising rates at historic levels and at a historic pace the last year or so, that just spells a little bit more turbulence for the markets, right? Markets don't like uncertainty. The stock market is forward looking, so it looks about 2 quarters at least in advance to see what the economic picture is going to be like. So when we don't really know what's going to be happening, obviously we think probably a shallow recession here in mid to late 2023, which has been pushed back by the strong and resilient economy and labor market that we've had, which again we'll dive into in here in just a second. But that just spells more near-term uncertainty. So with the markets not liking that, have been digesting that, there's going to be a lot of opportunity here in the near term for people to inject their cash, even fixed income, with higher interest rates, getting more bang for your buck. So again, looking like it's going to be a down week, fourth time in the last 5 weeks that we've had a down week. But again, that's okay. It happens. It happens in economic contractions. But again, if you look at recessionary times, recessions on average last about 10 months. Within the 6 months of the beginning of the recession, the stock market's already recovered to pre-recession highs. So again, not to worry, this happens. But let's dive into some economic news and jobs numbers. We added 311,000 jobs this past month, which is a little bit higher than the anticipated about 250,000 we thought were going to be added. One thing that I do want to point out is unemployment actually went up from 3.4%, which was a 5-decade low, to 3.6%. So we're starting to trend. The labor market's starting to loosen up a little bit, which is what the Fed wants to see as part of their dual mandate. But again, the economy is still really resilient. You had lower wage growth this past month, about 0.2%, which again is something that you're wanting to see is slowing wage growth, because wage growth has been a lot higher for people and companies that have wanted to hire workers. They've had to pay more, right? So wage growth has been higher, which fuels inflation. So we're starting to see a lot of the economic numbers that we've been waiting for to tick down. They're starting to. We just, again, want to see unemployment continue to go up, which is not good news, right? It's bad news is bad news, but good news in this case, because it'll stop the Fed from raising rates, which is what we want to see happen. But the main thing that I really want to focus on, again, you can read all about this week's news down below, but the big market moving news the past 2 days here on Thursday afternoon and Friday, as of this morning, why the markets are performing so poorly isn't because the Fed and raising interest rates. It's because it's bringing this big news story for the Silicon Valley Bank, SVB we call it. It's bringing back 2008, 2009 financial crisis vibes for a lot of people. There was a run on the bank, for those of you that don't know, because their investment portfolio at Silicon Valley Bank, which caters to a very niche clientele in Silicon Valley, a lot of tech startups, venture capitalism, which basically, again, startups, IPOs, things of that nature. That's how the bank makes their money. And with obviously higher rates, you're having less IPOs, less tech companies that are looking to grow or innovate or even start up at this point, because it's harder to borrow money with higher interest rates. So with that being said, the double whammy with Silicon Valley Bank is they made some poor investment decisions. They obviously got rocked. A lot of their investment portfolio was in the treasury bond market, which again, we had the worst bond market we've ever had last year. So the returns, their assets kind of whittled away, and they tried to raise money to try to get out of the debt hole that they were in. And it caused a run on the bank. People got scared, people got nervous, ran to the bank to try to get their money out, which is kind of what happened in the Great Depression. And then again in 08, 09, the California regulators actually shut down Silicon Valley Bank at this point, and the FDIC stepped in. So again, that's the kind of rocking the markets. Is it going to be more widespread? Is the contagion, excuse me, going to spread to other banks, regional, super regional, or even national banks? We don't think so at this point. Again, this was a very niche bank, very regional bank in Silicon Valley, which is tech heavy, right? So again, higher interest rates, they just weren't able to make as much money, made bad investment decisions, which is why they're in the position to sell their company that they're in, unfortunately. So we don't see anything that's going to be spread to other big banks. It's not going to be 08, 09, so everyone should remain calm. It's a big news story, but again, it's very regionalized. So we'll give you developing updates, but that's what I really wanted to cover today. Stick with your financial game plans, take the emotion out of investing, be a long-term investor. Having a long-term mindset is really going to be key here as we move into 2023, mid-year and beyond. So thanks so much. We'll see you next week.